Section 14, Reviewing Loan Types. Unit 1, Types of Loans and Financing Techniques. Lease with option to buy. One possible option for purchasers who may not be able to get traditional financing, but who want to own a home is a lease with an option to buy. An option is an offer. When the buyer exercises the option, the buyer is accepting the offer. Because options leave the seller hanging in a way, not being able to sell to another purchaser, they are only open for a specified period of time. Although the buyer pays the seller for the right to invoke the option, the buyer may not ever invoke it, in which case the fee is forfeited to the seller. If the optionee doesn't exercise the option before the expiration date, the owner is free to sell. Options with leases are often seen with prospective purchasers who can't purchase immediately but intend to soon, and would like to buy the property they are renting. Sometimes a portion of the lease payments will apply toward the property's purchase price, other times, all rental income is just that rental income. A breach of the lease terms may negate the option, and the prospective purchaser could even lose any portion of lease payments that were intended to go toward the purchase price. Right of first refusal. Similar to, but different from, a lease option is a right of first refusal. With a right of first refusal, the holder may purchase the property if the seller decides to sell to anyone. The order of events is this. The prospective purchaser asks for, and often pays a fee for, a right of first refusal. At some point, the owner may put the property up for sale or lease. Another party makes an offer to the owner. The holder of the right of first refusal now has to put up or shut up, either match the new party's offer, or allow the property to be sold or leased to the third party. If it helps, remember that with an option, all the cards are in the option holder's hands. The option holder can decide when and whether to exercise the right to the property. It's more proactive. With a right of first refusal, the holder of the right waits until an event occurs, a third party makes an offer on the property, and then must decide whether to exercise the right, or let the property go. This is a more reactive position. Interest-only payments. You've heard of interest-only payment plans, haven't you? Mike asked Kara. I have, Kara said slowly. But I'm not sure I really understand them. Do you mind explaining them to me? Not at all. Sometimes, mortgages offer IO, that's real estate agents speak for interest-only payment plans. With this type of payment, the borrower pays only the interest, just as it sounds, for a specific amount of time, usually 5 to 7 years. And then their payments increase? Kira asked. Actually, no. That's a different type of payment plan, which we'll discuss shortly. With an IO payment plan, after the borrower pays the interest payments for the established amount of time, we'll say the term is 5 years, for the sake of our discussion, then after that 5-year term, the entire principal is due. So, the borrower has to pay the entire loan off at once? Kira said, eyes widening. Well, yes and no. I mean, yes, with an interest-only payment, the periodic payments of interest only last for a few years. When the loan term is over, the borrower has to pay the remainder of the money owed, which is the entire principal. This is known as a lump sum. Lump sum, Kara repeated, jotting a note for herself. Exactly, Mike said. Lump sum means that all the principal of the mortgage remains. Maybe I'm missing something here, Mike, but why would someone take out this kind of loan, knowing that in 5 or 7 years, they'll have to come up with the entire principal on their house? I mean, let's say that a borrower buys a home for $100,000. They'll have to come up with $100,000 once their IO payments end? Mike smiled. Exactly. But, remember how I just said yes and no when you asked that? The reason I said that is because, yes, under the terms of the interest-only loan, or straight loan, as it's sometimes called, the borrower is required to pay off the loan once the IO payments end. However, most borrowers then finance the principal with another loan, so they're not stuck forking over $100,000 5 years down the road. Kara tapped her pen against her chin. Oh, okay, that makes more sense. But you didn't answer my question about why someone would choose this type of loan. Well, many people who take out IO loans do so to keep their first few years of payments low. For example, people in certain professions expect a significantly higher income after their first few years, and so it makes sense to keep their initial payments as low as possible, Mike said. Kara nodded. That makes sense, too. But the thought of possibly being asked to fork over $100,000 or more after 5 years of living in a house would give me hives. I mean, what if I weren't approved for another loan to finance that lump sum? No thanks. Remind me to avoid IO payments when it's time for me to buy my first house. Mike held up his hand, Boy Scout style. I promise. I knew I could count on you, Kara said. Loan types. Mike had gone to his car for a folder, and when he returned he extracted a paper and handed it to Kara. I have to head home now, soccer game for Emily, but this is something I give to my clients and also any licensees I work with. It summarizes loan types and terminology. You might find it helpful. Thanks. It's been great to meet you, Mike. Likewise. Call anytime. Will do. When Mike left, Kara looked over the paper he'd given her. Yes. This would be very helpful indeed. Handout, take a look at the loan type chart Mike handed Kara. Mortgages and mortgage insurance. Borrowers can choose from many different mortgage products, but most of those products fall into one of two categories, unless the borrower is getting financing from the seller or some other private source. Mortgage loans are usually either conventional or government loans, such as those insured by the Federal Housing Administration, FHA, or those guaranteed by the U.S. Department of Veterans Affairs, VA. With a conventional loan, if the loan-to-value, LTV, ratio exceeds the lender's threshold of 75% to 80%, the lender may require the borrower to purchase private mortgage insurance, PMI, though there are some conventional loan products with much lower down payments that don't require PMI. Loan term. Borrowers should consider how long they plan to be making mortgage payments when deciding on the loan term. A 30-year mortgage may have a lower monthly payment, but what will happen if the loan term extends beyond the period during which the borrower will have a steady income? Conversely, a couple purchasing a retirement home may prefer a 15-year mortgage in order to have no mortgage payment when they plan on living on a fixed income. Conventional loans and private mortgage insurance. PMI protects the portion of a mortgage loan not covered by the down payment. It shields the lender if foreclosure becomes necessary. Lenders figure that if borrowers have more of their own money at stake, they're less likely to default. In addition, the higher the down payment, the less the lender has to get out of the property at a foreclosure sale in order to break even. PMI termination. PMI may terminate automatically or at the borrower's request under certain circumstances. Automatic termination. The PMI Act of 1998, the Homeowners Protection Act, requires lenders of loans created after 1998 to automatically cancel PMI when the borrower's equity is scheduled to reach 22%, an LTV of 78%, based on the original value, the lower of the purchase price or appraised value. Borrowers must be current on payments for this to occur. Borrower requested termination. Borrowers may request that lenders terminate PMI when the principal balance on the loan is scheduled to reach 80% of the home's original value. Borrowers must be current on payments and have a good payment history. They must request the termination in writing and may be required to prove that no junior liens on the property exist. Borrowers may have to provide evidence, such as an appraisal, that the property value meets an 80% LTV. This process can take several years, of course, because payments are primarily interest in the beginning. If the market is appreciating, however, or if borrowers have made substantial improvements to the property, they may reach this point earlier in their loan term. Final termination. If borrowers are current on payments, the lender must terminate PMI 1 month after the loan reaches the midpoint of its amortization schedule, even if the LTV isn't yet 78%. This is most likely to occur for borrowers who start out with a negatively amortized loan, interest only, some sort of balloon payment, or a balloon mortgage. FHA loans and the mortgage insurance premium. FHA financing is popular because borrowers with lower credit scores and smaller down payments, as little as 3.5%, can still get a mortgage loan. The Federal Housing Administration insures loans for lenders that meet certain underwriting criteria. Borrowers must pay a mortgage insurance premium, MIP, for the life of the mortgage loan, so it's wise to encourage them to weigh all of their options before deciding which type of loan works best for them. Borrowers pay a portion of the MIP at closing. The remaining premium is prorated and built into the monthly mortgage payments. FHA doesn't set a maximum sales price or focus solely on borrowers with lower credit scores and smaller down payments. There is a maximum loan amount, however, so borrowers must pay anything above that in cash. VA loans. A VA loan is another type of government loan that is strictly available to members and former members of the armed services. VA loans are guaranteed by the U.S. Department of Veterans Affairs. Veterans can pay as little as nothing down, and the VA doesn't allow lenders to require mortgage insurance.